Howdy folks, Mitchell Kuhn with Wisdom Financial here. I'd like to talk to you today about why this time is different, but it's really nothing new. So I spend most of my time following financial markets, studying history, and helping my clients make wise decisions for their retirement in a rapidly changing world. And I want to give you some perspective on how much things have changed over the past 50 years. Yet it's really just a repeat in many ways of what governments and political leaders have been doing over and over since the beginning of time. So we've all heard the phrase, those who do not learn history are doomed to repeat it. Well, this is actually a rephrasing of a quote from George Santana in the late 1800s. And originally it was written, those who cannot remember the past are condemned to repeat it. So we will do well to be students of history, see what we can learn, and try to glean some wise principles going forward. So let me teach you about a pattern that's been going on for some time. So a poor and oppressed people group labor very diligently to rise from poverty and to build a great country or empire. This is usually due to a very strong set of moral values, a well-organized and political system, and they have sound money. Currency backed by silver, gold, some real asset that you just can't create out of thin air. You've got to labor hard to dig it up from the ground and separate it, melt it down, and get the dross off. And that helps constrain the spending of these people based upon the labor they do. Now, as wealth increases in the country and the people group grows, greed sets in. And they want to expand their empire beyond what they have, and they don't have the money to do it. Usually it's often wars that lead to these problems. So the leaders, in order to fund all of this, they start to devalue the currency and essentially create money out of thin air to be able to fund their reckless spending and their wars and all the things that they promise. Then they begin to slip deeper and deeper into moral depravity while also falling deeper and deeper into debt. All the foundational principles and guidelines and wise things they did to build the country start to fall apart and not be followed. And that leads to a loss of confidence in this new devalued currency, and the country begins to fall apart. So this is basically exactly what happened to the Roman Empire. The empire was built on discipline, both morally and fiscally, a strong sense of morality. They had real sound money backed by gold and silver. Their primary currency for daily trade was silver, which was 95% pure. If you had a silver coin, it was really made of silver, around 65 BC. By 268 AD, about 300 years later, we start seeing less than 5% of the coin is made of silver. So they devalued the currency so they could make more of these coins. They said they had the same value, but they really didn't. And that was how they funded a lot of their wars and spending. This is the ancient equivalent of modern day money printing, which we've just given a fancy term. We call it quantitative easing. So in Rome, the devaluation of their currency and reckless spending eventually led to hyperinflation. There had to be rising taxes to be able to deal with these new expenses. And the political system also became increasingly corrupt. You can read about all of the murder and infighting and coups inside of Rome, especially in the latter stages of the empire. All this political and financial turmoil eventually led to the demise of the Roman Empire. A house divided can't stand, and once the infighting started, it didn't go very well. Now, the United States is not that old, about 240 years. And this country was founded with a very strong sense of morality and sound money. So you had a people fleeing from Europe to have religious freedom, and they wanted to build a great country, and they did. And they had real money backed by gold and silver. You could redeem your money for gold, and that constrained the spending. In 1933, things really started to change. And President Roosevelt issued Executive Order 6102, which made it illegal to hold gold. This was the beginning of the U.S. abandoning sound money. And then in 1971, President Richard Nixon completely removed any ties between the dollar and gold. And this change paved the way for massive debt expansion and reckless spending, not only in the United States, but all over the world. Because what happened after World War II was they brought in the Bretton Woods system. The US had accumulated a massive amount of gold reserves coming out of World War II, and they basically said, hey, rest of the world, you tie your currencies to the dollar, and we will back the dollar by gold. So the world, was basically on a somewhat of a gold-based standard. Well, in 71, the government in the US wanted to spend more money than they had, so they disconnected that, and by doing that, it essentially removed gold from behind all the major currencies in the world. And that was the beginning of a worldwide global fiat currency system. So just as the Roman emperors put less and less silver in the coins, the leaders of the United States and now the majority of the world have created money out of thin air. There's nothing real backing our currency. So I want to show you the consequences of what this does when you remove sound money from the world. Look at this debt chart from 1937 to present day. The debt didn't grow very much from the 30s till the 70s. We had about $1 trillion of debt in the 1970s. And then from then until now, it's become over $19 trillion. And really the majority of that has been added fairly recently. In the next recession, the Federal Reserve released a report and they said they're projected to print $4 trillion to stave off the next recession. Almost a 25% increase in the debt. So what's also been going on at the same time is rising political corruption. It is kind of ironic that the very person that completely disconnected us from the gold standard, Richard Nixon, was impeached in the Watergate scandal. So the expansion of debt in a country is usually accompanied by a decline in moral values. Debt is a manifestation of greed and a lack of patience. So just look at what's on TV today versus the 1960s. On the Dick Van Dyke Show, the censors wouldn't even allow Rob and Laura to sleep in the same bed and show that on TV. So they had twin beds for Rob and Laura. Now, the opening scene to many primetime TV shows is unmarried people in bed together. And this is becoming common. It's just one very small example of the decline in morality we're experiencing in our country. So just as debt is becoming much more rampant, so is this decline in morality. And it's not just isolated to the United States. It's in every major country in the world. There's been a worldwide movement away from sound money backed by precious metals and the widespread acceptance of a debt-based fiat currency. And also we're seeing the corruption in our political system is becoming much more obvious every day. The advent of social media, websites like WikiLeaks, YouTube, the ability to uncover what's going on behind the scenes is becoming very widespread. So the corruption is becoming much more well known. So you say, what does this have to do with retirement planning? Well, history could be repeating itself, and we best give that some consideration. We should be good students of history and see if we can gain some principles for retirement planning based upon that. So there's essentially two opposite extremes, two opposing views you're going to see in the media and in news sources when you research these topics. So the major financial institutions, the mainstream media sources are going to tell you that everything's fine. The financial crisis is over, it's all been healed, and now it's sunshine, rainbows, and unicorns forever. The other side of the road points out the problems and the flaws and the ways that we're doing the same things all over again. And the doomsayers will say we're facing massive financial devastation just around the corner. A lot of these people that point out these problems made some very good points before the dot-com bust in early 2000s, and they made some good points before the financial crisis of 2008. So what's the truth? Who's right? Well, the answer is found somewhere in the middle. Where all the doomsayers get it wrong is that they don't know the timeline. They don't know how long it's going to take for the serious consequences to manifest. You know, the insanity of money printing and negative interest rates could go on for quite a while longer. I want to stop for a second and just explain negative interest rates to help you realize how unusual this is. So negative interest rates basically says, hey, why don't you loan me $1,000 and I'll give you back $900 in 10 years. Is that a good deal as an investor? You're basically guaranteed to lose money in this investment. It doesn't make any sense. And this is why this time is different. It's a new, strange problem that we really haven't dealt with before. So what's the answer? How do you deal with all this conflicting information? Things are changing. What do you do about it? Well, this is what I'm doing for myself. I'm a consumer too. I have to invest my money. I have to make retirement planning decisions for myself and my family and my clients as well. So here are some general principles that I'm gleaned from studying this for many years. So number one is, it's wise and prudent to protect your retirement savings from market downturns. You spend most of your life accumulating wealth so that at some point you can stop working and live off of that wealth in retirement. So for most people, it's pretty difficult to lose a large percentage of those retirement savings when stock markets have a major downturn. Now, most financial advisors are still making decisions about your portfolio based on something called modern portfolio theory, developed by Harry Markowitz in the 1950s. This is what I was taught in my finance degree at SMU. It's what's taught in a lot of the certified financial planner programs and money management programs. It is a key tenet in money management. And what it basically says is, have a diversified portfolio. In the 1950s, Harry Markowitz said, look, if you own some U.S. stocks, some U.S. bonds, some international bonds, international stocks, not everything is going to be down at the same time. These assets are non-correlated. They don't move completely together. And that gives you some protection. Well, think about how much has changed since the 1950s. Look at technology, the internet, the way that stock market trading is going on. Things happen much faster and the world is moving much more together as a global economy. Now, when the US market went down in 2008, we saw Europe and a lot of the rest of the world went down at the same time. So there is now becoming more close correlation between the asset classes. Another very interesting thing happening is typically going into a recession. You're coming to the end of a big bull market. And as markets heat up and grow, interest rates are supposed to rise. The Federal Reserve is supposed to raise those interest rates to keep the economy from overheating. And then as the market starts to roll over, they begin to lower the rates to supposedly smooth out the ride so the ups and downs are smaller. Well, going into 2008, we had normal interest rates. They were about 5%. They went down to zero at the end of 2008 to help recover from the financial crisis. Well, in the past, generally the rates have risen over time, so right now they should be back up at 5%. Where are they? They're at zero. So here we are, 8-9 years later, and we're still at zero. This causes big issues in the bond market because normally when interest rates go down, prices of bonds go up. So think about what happened in 2008. Interest rates went to zero. What happens to bond prices? They go up very, very high, right? So now bond prices are high at the same time that stock prices are high. So when the next recession comes in, there's no room to lower the interest rates. So we're starting to see stocks and bonds are moving more closely together. So the Federal Reserve is concerned about this. And they've been asked the question, how are you going to stave off the next recession when interest rates are already at zero? And so their last report says they're going to print $4 trillion. This is a new problem that modern portfolio theory built in the 1950s wasn't really aware of. It wasn't really designed to deal with that. So in our opinion, and many experts are in the same camp, there may be some new, more modern management styles that are better suited to deal with a global economy where we have more closely correlated assets and we have a lot more volatility. I mean, just think about it. In 2000 to 2003, we had a 40% drop in the market. It took about 6 years to get back to the same level it was before the dot-com crash, and then we had a 50% drop in '08. That's a lot of volatility in a 15, 16-year period. Now, no one can say exactly when the market's going to roll over again, but when it does, it would be wise for you to consider, is the theory that my portfolio is built upon going to perform as well this time as it has in the past? And if not, then that's something to think about. Point number 2 is you may want to consider a fixed indexed annuity. So every investment has a pro and a con. Some money managers out there think fixed index annuities are terrible, and they say they wouldn't touch them with a 10-foot pole. And other money managers say they're fantastic and you should have the majority of your wealth in there. Well, there's a narrow way here again. There's a balanced approach to this. So annuities do some things well. What they do very well is they protect you from downside market losses, and they can give you a guaranteed monthly income that will last the rest of your life as long as you live. Well, that can be very reassuring for people who want their monthly check to come in no matter what the stock market does. So before you chuck annuities out the window and just write them off because you hear one person talking bad about them, do the research for yourself and see. It may or may not make sense in your portfolio. Just make an educated decision and understand why you're either incorporating them or not in your portfolio. Point number 3 is you may want to consider some gold and silver. So precious metals have always been currency since the beginning of time. And whenever fiat currencies have collapsed in the past, and there's been many fiat currencies over the years, they've generally returned to gold and silver for stability. So we can't say when confidence is going to be lost in this current global debt-based fiat currency money system we're in, but whenever it happens, gold and silver could become quite valuable again. So again, it would be prudent to just consider, does this make sense as a portion of my portfolio to have something to help protect what I've worked so hard to earn? And the last point is get out of debt. Debt is a major cause of the volatility and the problems we're facing in the world today. And just like it causes problems on a grand scale for countries and governments and economies, it will cause problems in your own life if it's not managed very closely. So it's not just about how much you save, it's really about how much you spend. And if you have a lot of debt, it probably means you have a spending problem. So if you want to feel wealthy, if you want to feel like you have some margin in your life, then try to pay off your debt, live within your means, and you're going to be a lot happier in retirement. So the folks that I have the easiest time building financial plans for is they come to me and they don't have a mortgage and they don't have car payments. They have low monthly debt requirements, and it makes it much easier to support the lifestyle that they want to live. So I've given you a lot to chew on today. If you want some help to learn how to follow these principles, how I do it for myself and my family, I really like to teach people how to be a good informed consumer. I want to teach you how to ask the right questions about investments and alternative investments and insurance products and budgeting and retirement planning. If I can teach you those principles, then you have the tools to now go make good, wise financial decisions. So please give me a call, shoot me an email. I'm easy to get a hold of. I'll help you do the research. I'll share with you the research that I've done, and may be able to help you build a wise retirement plan. So thank you very much for listening, and I hope I have helped you have a better retirement. Have a great day. Goodbye.